The silver market did not just rise today. It experienced a mathematical breaking point. What you are seeing on the charts, a vertical move of $61 in a single trading session, is not a rally. It is a glitch in the global pricing matrix. We are witnessing a market that has teleported through a liquidity vacuum, creating an 8% gap that the algorithms in New York are struggling to comprehend. In this briefing, I am going to show you why a massive arbitrage window has opened between the East and the West, creating a suction force that is draining physical inventory from the vaults. We will analyze why the law of one price has been violated, and why the industrial supply chain has quietly entered a state of panic that the mainstream financial press is largely ignoring. This is not a story about speculation. It is a story about the day the paper market snapped under the weight of physical reality. To understand the violence of today's price action, we have to look past the daily noise and observe the structural fracture in the global marketplace. For decades, the price of silver has been dictated by the futures markets in London and New York. That mechanism is currently failing. We are looking at a market that is trading at roughly $78.83 in the United States. That represents a gain of 8.25% in one day. Normal markets, healthy markets, do not move 8% on a Tuesday morning without a catastrophic catalyst. This movement is the sound of a vacuum. It confirms that the float, the available inventory for immediate trade, has vanished. For weeks, the data has suggested that the price in the West was artificially low, trading at a steep discount to the rest of the world. We warned that New York was trading at a discount to reality. Today, the elastic band finally snapped. The United States price is frantically chasing the global price. But here is the critical data point that most traders are missing. Even after this massive explosion, the West is still behind. We just received the settlement data from the Shanghai Gold Exchange. While New York is celebrating at $78, China is trading at nearly $84. There is still a $5 gap. In the world of high-frequency finance, a $5 spread on a commodity is not just an inefficiency, it is an irresistible magnet. The market cannot sustain two different prices for the same asset forever. It violates the fundamental economic law of one price. This gap is acting as a gravitational force, pulling the US dollar price higher to meet the renminbi price. The pricing power has shifted east, and the West has no choice but to follow. This is the anatomy of the $6 candle. To understand why silver moved $6 today, you have to understand the physics of a hollow market. In a liquid environment, there are sellers at every price level. Someone sells at 73, someone sells at 74, someone sells at 75. The price has to chew through these orders to go up. It is a slow grind. But today, there were no sellers. The ask side of the order book was empty. The bullion banks, who usually sell futures contracts to cap the price and manage volatility, stepped away. They stepped away because they are terrified of the Shanghai price. They know that if they sell silver at $75 in New York, they are essentially giving away free money to anyone who can ship that metal to China for $84. So the banks pulled their sell orders. And when the buyers stepped in, the pension funds, the industrial hedgers, the algorithms, they found an empty room. They hit market buy, and the price skipped. It teleported from 73 to 78 without meeting any resistance. This volatility is not a bug. It is a feature of a shortage. When you run out of physical buffer, price becomes the only shock absorber left in the system. Let's look deeper at the mechanics driving this move, specifically the behavior of the arbitrage traders. These are the most ruthless actors in the financial ecosystem. They do not care about technical indicators. They do not care if the relative strength index is overbought. They only care about the spread. They are currently buying every single contract they can find in New York to close the gap with China. As long as New York is cheaper than Shanghai, this buying pressure will remain relentless. The arbitrage vacuum is still open. The pressure is still equalizing. We are witnessing the US dollar price being dragged up by the global physical price. Now we must spare a thought for the short sellers. Imagine you are a hedge fund manager who shorted silver last week at $75, assuming it was a double top on the chart. You woke up this morning to a $6 loss on a standard futures contract. In the futures market, leverage amplifies everything. A $6 move against a position creates a loss of approximately $30,000 per contract. If a fund held 100 contracts, they lost $3 million before they finished their morning coffee. This triggers a forced liquidation event. The risk manager at the brokerage firm takes over the account. They do not ask the trader what to do. They simply hit buy. They buy at 76. They buy at 77. They buy at 78. They are price inelastic. They just need to exit the position to stop the hemorrhage. This short covering acts as rocket fuel. It is panic buying from the institutions themselves. It hits a market that already has no sellers, creating a feedback loop. The higher the price goes, the more shorts get liquidated. The more shorts get liquidated, the higher the price goes. We are in the middle of a gamma squeeze and a short squeeze simultaneously. It is a perfect storm of financial pain for the bears. But silver is not the only signal flashing red on the dashboard. To understand the severity of this move, we must look at the bedrock of the financial system: gold. Gold just made a move that is statistically rarer than the silver spike. Gold is trading at $4,467. It is up $135 in a single session. That is a move of over 3%. To put that in perspective, a 3% move in gold is the equivalent of the Dow Jones Industrial Average moving 1,500 points in a day. It is a black swan event. It does not happen during normal trading. It happens during the invasion of Ukraine. It happens during the collapse of Silicon Valley Bank. It happens during the Great Financial Crisis. When gold moves 3%, the market is screaming that something in the financial system has broken. It is a systemic distress signal. The smart money, the central banks, the sovereign wealth funds, are fleeing the dollar. They are fleeing the bond market and piling into the only asset with no counterparty risk. This validates the silver rally. Silver is not going up because of a retail squeeze on Reddit. It is going up because the entire monetary order is being repriced. Silver is simply drafting behind the king. And in finance, we have a concept called high beta. Silver is historically gold on steroids. It has a beta of roughly 2 or 3 against gold. If gold goes up 1%, silver goes up 2 or 3%. Today, the math held perfectly. Gold went up 3%, silver went up 8%. This correlation is your safety net. If silver was up 8% but gold was flat, I would tell you to be careful. That would look like a speculative bubble. But because gold is leading the charge with a historic move, silver's move is justified. It is foundational. We have to ask, why today? Why did gold rip $135 on a Tuesday in January? We know about the geopolitical headlines, the news from Venezuela, the tensions in South America. But usually geopolitical news spikes the price for an hour, and then it fades. This rally didn't fade, it accelerated into the close. This suggests that the geopolitical risk is morphing into a financial risk. The market is sniffing out a problem in the bond market or the banking system. When gold rises this fast, it usually means that a major institution is in trouble or a major currency is about to devalue. We are seeing insider buying. Someone knows something that hasn't hit the headlines yet. The price is the news. The price tells us that safety is suddenly in very high demand. We have analyzed the financial fireworks, but financial markets are just a reflection of the real world. And in the real world, on the factory floors of Korea, China, and the United States, a different kind of panic is setting in. It is one thing for a trader to miss a move on a chart. It costs him money. It is another thing for a factory manager to miss a shipment of silver. It costs him his business. Today, with silver exploding $6 in a single session, the global supply chain just had a heart attack. We need to pivot to the industrial front line to understand the concept of inelastic demand. I want you to imagine you are the chief procurement officer for a major solar panel manufacturer or a semiconductor giant like Samsung. Your factory produces millions of dollars of product every day. To make those panels or chips, you need silver paste. Silver makes up maybe 5% or 10% of your total unit cost. Yesterday, silver was $72. Today it is $78. Does this price hike make you stop buying? No. Because if you stop buying silver, you cannot finish the panel. If you cannot finish the panel, you cannot sell it. You lose 100% of the revenue because you tried to save 5% on the cost. This is price inelasticity. The industrial buyer is not sensitive to the price. They are sensitive to availability. When the price spikes $6 in a day, the procurement officer doesn't think, it's too expensive. He thinks, there is a shortage. I need to buy more now before it runs out. So the price spike actually triggers more buying. We are seeing reports of industrial users doubling their orders. They are switching from just-in-time delivery to just-in-case hoarding. They are draining the supply chain to build a buffer. This is the inventory supercycle, and it turns a price spike into a price spiral. Simultaneously, look at the retail bullion dealers, the companies that sell silver to the public. Today was a nightmare for them. Imagine you are a dealer. You own 10,000 ounces of silver. You bought it for $70. Suddenly, the spot price rips to $78. You should be happy, right? You made a profit. But you have a problem. If you sell that silver to a customer today for $79, you have to replace it. But the wholesale market is chaotic. The refiners are raising prices. The Shanghai magnet is sucking up inventory. What if, by the time you go to restock tomorrow, the price is $85? You just sold your inventory at a loss relative to the replacement cost. You sold gold to buy lead. So what do dealers do in a vertical market? They widen the spreads, they jack up the premiums, or they simply pull the inventory out of stock, call for pricing. They are freezing sales to protect themselves from volatility. This creates a physical lockout. The screen says silver is $78, but you cannot exchange your paper dollars for metal at that price. The real price, the price to get metal in your hand, is rapidly approaching $100. The paper market is lagging the physical reality by $20. We also have to look at the macro calendar. The US debt ceiling deadline is approaching in Q1. The Treasury is running out of cash. The bond market is getting nervous. A 3% move in gold is often a vote of no confidence in the government's ability to pay its bills without printing money. The market is pricing in fiscal dominance. This is the economic theory that dictates the central bank will be forced to print money to fund the government, regardless of inflation. When fiscal dominance kicks in, fiat currency loses value rapidly. Hard assets re-rate to infinity against the dying currency. We are watching the market realize that the debt spiral is terminal. There is no way out except inflation. And if you know inflation is coming, you buy gold, you buy silver, and you buy them now at any price. That is the panic we saw today. It wasn't speculation. It was an exodus from the dollar. We are approaching a zone technicians call blue sky. Above $80, there is no chart history. There are no resistance lines from 20 years ago. There are no bag holders waiting to sell to get their money back. Everyone who owns silver is in profit. When a market enters blue sky, the rules of gravity change. Price moves faster because there is no overhead supply. The only resistance is psychological. $80, $90, $100. These are walls only because they are round numbers, not because there is actual selling pressure there. This means we could see volatility expand even further. If we move $6 today, we could move $10 tomorrow. Do not be scared of the speed. Speed is what happens when a compressed spring is released in a vacuum. The market is trying to find a price that balances the books. And since the Shanghai price is $84, the books are not balanced yet. We have to go higher just to reach equilibrium. Now, we must address the psychological trap, the urge to sell. You see the profits in your account. The numbers are flashing green. Your brain screams at you to lock it in. But lock it into what? Dollars? Think about why silver is rising. It is rising because the dollar is falling against real assets. It is rising because the debt is unpayable and war is expanding. If you sell your silver at $78, you are trading a safe haven for a risk asset. You are trading the lifeboat for a ticket back onto the Titanic. The smart money does not sell for cash during a currency crisis. They swap. They trade one undervalued asset for another. They wait for the gold to silver ratio to tell them it is time to move. Right now, the ratio is 56. Historically, in the mania phase of a bull market, this ratio collapses to 40, then 30, then 15. We are still at 56. This tells us that despite the 8% rally, silver is still undervalued relative to gold. It has room to double against gold, even if gold does not move another inch. The strategy for the institutional investor is not to sell, but to hold until the ratio signals a swap. Furthermore, the public is not here yet. Today's 8% move will be on the news tonight. It will be on social media tomorrow. The average person is just waking up to the fact that silver is the asset of the year. They haven't bought yet. They are still opening their accounts. They are still driving to the coin shop. This means the retail wave is still ahead of us. We are in the institutional phase. The institutions are buying, the public is watching. When the public starts buying, that is when the price moves from 80 to 150. You do not want to sell before the mania. You want to sell into the mania. Closing reflection. The verdict on the Shanghai explosion is clear. The market mechanism has broken. The West lost control of the price because they lost the physical metal. The East is setting the price because they have the demand. The arbitrage gap is forcing a revaluation of the entire precious metals complex. $78 is not a bubble. It is a correction to reality. The reality is that silver is scarce, strategic, and essential. The paper price was a distortion for 40 years. Today, the truth came out. We are watching the checkmate of the fiat currency system. The king has moved. The knights are following. In the end, this isn't about markets going up or down. It's about who understands the system and who doesn't.